Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everybody. So markets rallying a little bit at this point in the day. Anything can happen, though, of course, in this short gamma environment. So JP Morgan's David Kelly saying the trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that, they are fine. So obviously, the problem is they are not fine. We had a little bit more data here. ADP non-farmer employment change came in lower than expected. ISM came in lower than expected. Confidence from individual consumers and businesses coming in lower than expected, starting to wane. So these things can change very, very quickly. You think things are sort of a slow moving ship, but we are seeing some evidence of things changing very, very quickly from this situation. And it could be the beginning of a very, very difficult situation for the economy if we don't right the ship a little bit. So we can see that overall, from a positioning standpoint, macro systematic length, 80th percentile. So what that means is most systematic kind of strategies are very, very long. They really haven't deleveraged to a great extent. And if you add to that the vol targeting, all the CTA buying, of course, is sort of part of what we're talking about here. Lots and lots of stock for sale if this market does not cooperate. Now, we're getting a little bit of a bounce here, but I'd say the kindling is still very, very much in place, as I've been talking about for a couple of weeks now, for the downside to continue if this market really feels like getting going to the downside again. That could start the acceleration process once again. So markets now looking at 3 rate cuts being priced in, really from worries a couple of months ago that we were potentially going to be looking at rate hikes, right? A strong economy, rate hikes. The markets were not ready for this, and this is a very, very new picture with things deteriorating rather quickly. Let's take a look at some of this. Corporate capital spending plans reversing down hard. Fewer people planning vacations. Listen, regardless of what you think about the haves and have-nots, the wealthy have been very much a part of keeping the economy going. And if they're not spending, they're not spending. So a lot of folks out there who have that disposable income are starting to pull back again, right? This is uncertainty, right? A lot of companies have come out and said some headlines this morning saying the not knowing is the worst part. It's freezing up companies who want to proceed with their plans for the year, and they can't do it because they don't know what's happening out there. So this is quite a negative. Consumers expecting fewer jobs available going forward. This is not a good situation from a consumer sentiment standpoint. Paying the price of tariff risk. Nasty surprise on the manufacturer's price demonstrates the uncertainty. Look at prices starting to pop up. So the Trump trade has almost completely unwound. Look at this, SPY versus TLT. Hey, everybody, if you haven't done so already, please like and subscribe below and sign up for my free 4-day options trading challenge course. Every day, you're going to get a new lesson describing in detail my 4 pillars of edge that I use as a professional to approach the art of options selling for income trading. Check it out below. Growth coming down, of course, versus value. Here's Russell 3000 growth versus value really coming down. Bitcoin kind of bouncing around a little bit. And then the S&P versus the rest of the world. We've seen Germany hitting all-time highs. Some names over there. There's one big arms manufacturer just literally going parabolic to the upside as they have to start to foot the bill for a lot of their military spending. Magnificent Seven having some trouble, right? So I think we're going to get to the point where potentially Mag 7 starts to look a little bit interesting because they tend to also be a little bit of a safe haven. Of course, there's cyclicality to these names, but they have these balance sheets, the balance sheet heroes, as I call them. So potentially very, very strong companies that can withstand, and of course have these franchises, these monopolies on certain areas of the economy. They'll probably do okay, but in general, and I pointed this out the other day. In general, we're starting to see interesting bounces in sort of low volatility. Those names that you really don't think about as much anymore. I did a video on that the other day. I encourage you to go check it out. I'll put it in the description, but some things to really, really think about. So rate forecasts coming down. Ultimately, I think that's a positive. Of course, they're coming down not for slowing inflation, but for the wrong reasons, in a sense, for slowing growth. So this isn't all good, and that's basically why the market is reacting this way. A couple months ago, it was going to applaud any potential rate cuts because of inflation starting to come down. In this case, this is pricing in this growth scare that everybody's thinking about. So things are happening very, very quickly out there. And quite frankly, if Trump doesn't figure things out, if we don't sort of smooth over the situation, this could really, really turn into some sort of difficult backdrop for markets, for the economy. We're seeing that sentiment eroding, corporate sentiment eroding. They're going to be holding back on spending decisions. Plus, we've got the DOGE stuff going on, which has an impact on employment. That's, I guess, arguably deflationary to some extent, but will put upward pressure on the unemployment rate. So lots of things in flux, and that's really being reflected in these markets that are very, very jittery. We'll see you guys in the next video.